Welcome back to Talk Tickers. I'm your host, and today we are bringing you another deep dive. And our mission today is really to decode the Q1 2026 earnings call of Texas Pacific Land Corporation.
Ticker symbol, TPL.
Exactly, TPL. And usually when you think about a 130-year-old land holding company, there is this expectation of dust.
Yeah.
You picture, I don't know, old filing cabinets, sepia tone maps, maybe some tumbleweeds blowing across a desolate West Texas highway.
Totally. You think of this antique business model that just quietly collects small checks while the modern economy just, zooms right past it.
Right. But then you step into the specific Q1 2026 earnings call, and suddenly that antique map is glowing like a motherboard.
It really is. It's wild.
It's a massive plot twist. We're talking about a company founded in, 1888?
Yeah, 1888.
Right. And suddenly it's positioning itself at the absolute bleeding edge of the artificial intelligence infrastructure boom. So for you, our listener, the retail investor, we're going to keep this actionable data forward and concise. We'll hit the headline numbers, the story behind those numbers, what management is saying about the future, and finally, the ultimate bullish or bearish bottom line.
And, the broader market has historically treated these legacy land trusts as, sleepy, predictable, almost boring entities, right?
They're very boring.
Yeah. But what makes this particular quarter so jarring is how TPL has taken that passive legacy model and completely weaponized it for the modern energy and compute bottlenecks.
Weaponize is a good word for it.
Right, because they haven't actually changed their core identity. I mean, they are still fundamentally leveraging the surface and subsurface rights of massive tracts of Texas land.
Still a land company.
Exactly.
Yeah.
But the application of that land has shifted dramatically, and the financials are reflecting a scale of monetization that the market is frankly really struggling to price in right now.
Okay, let's unpack this because we need to start with the sheer financial gravity of this quarter.
Yeah, let's hit the numbers.
The primary figures from the transcript are just staggering. Q1 2026 brought a record-breaking $237 million in consolidated revenues. Yeah, that is a 12% sequential increase from the last quarter and a massive 21% jump year over year.
It's incredible growth for a supposedly sleepy trust.
Right. And free cash flow hit an all-time high of $136 million.
Wow.
Consolidated adjusted EBITDA came in at $181 million, which is up 7% over last year. So if you hold this stock, or if you're looking at the energy and AI sectors wondering, how to play this infrastructure bottleneck, you really need to understand the mechanics here.
For sure.
How does a land trust print $136 million in free cash flow in a single 90-day period?
Well, to contextualize that free cash flow, you have to look at their capital expenditure profile.
Right.
Or really the total lack of it.
Right, the lack of it.
Because TPL operates primarily on a royalty model. So they reported oil and gas royalty production averaging 37,100 barrels of oil equivalent per day, which is a 19% increase year over year.
That's a lot of oil.
It is. But here's the kicker. TPL is not an exploration and production company. They are not buying massive drilling rigs. They aren't, hiring thousands of roughnecks.
Or taking on billions in debt.
Exactly. Taking on billions of dollars in debt to pull that oil out of the ground. Other operators are deploying all that capital to drill on TPL's land, and TPL simply takes a percentage of the revenue right off the top.
Just right off the top. The technical term they use in the filings, and we translate Wall Street jargon here on Talk Tickers, is a non-participating perpetual oil and gas royalty interest.
Or NPRI.
Right, NPRI. And non-participating is the magic word there for the balance sheet, isn't it?
Oh, absolutely. It's everything.
Because they don't participate in the cost of drilling or completing or operating the wells. They just perpetually own the right to a fraction of the hydrocarbons produced. The sources note they hold a 1128th NPRI under about 85,000 acres and 116th NPRI under 371,000 acres, totaling something like 224,000 net royalty acres in the Permian Basin.
Yeah, and that 116th fraction sounds incredibly small to a layman, right?
Like a tiny sliver.
Right. But when you apply it to the most prolific oil-producing region on the planet, it translates to just astronomical margins. I mean, free cash flow is the cash left over after a company pays for its operating expenses and capital expenditures.
Yep.
And because TPL's capital expenditures are just a tiny microscopic fraction of a traditional oil operator, their operating leverage is massive.
So that $136 million in a single quarter.
It is purely available to benefit shareholders through dividends, share repurchases, or reinvesting in the new technologies we're going to discuss later.
Okay, so hitting record numbers is great, but as an investor, you need to know how they did it. Looking at this quarter's specific drivers, the intense completion activities were concentrated in the Delaware and Midland Basins, right?
Yes. Specifically, the transcript calls out Occidental, BP, and Devon.
The heavy hitters.
The biggest players in the game. They are aggressively operating in Loving and Northern Reeves counties on TPL land. These are massive multinational corporations deploying immense capital, and TPL is basically acting as the toll collector.
The toll collector, I like that. But acting as a toll collector on an oil highway assumes the traffic never stops.
Oh, yeah.
And this brings us to a part of TPL's financial strategy that honestly always raises eyebrows for me. They are completely unhedged.
What's fascinating here is, well, in the oil and gas industry, hedging is standard practice.
It's table stakes.
Totally. Exploration and production companies, the E&Ps, they routinely use financial instruments, futures contracts, put options, you name it, to lock in a specific price for their future oil production.
Because they have to.
Right. They carry immense debt loads. If an operator borrows, say, $3 billion to fund a multi-year drilling program, and the price of crude crashes... Exactly. They cannot service that debt. They hedge to guarantee a baseline revenue and ensure corporate survival during a down cycle.
Okay, but I have to push back on the wisdom of TPL ignoring that practice.
Go for it.
It's like driving without a seatbelt.
Well,
if we look back at the historical carnage in the energy sector, think about the 2014 shale crash.
Sure.
Or the apocalyptic demand destruction in April 2020 where WTI crude actually went negative.
Oh yeah, negative $37 a barrel,
right.
Remember.
Unhedged commodity businesses were absolutely obliterated. Chesapeake Energy is a prime historical example of a company that flew way too close to the sun with leverage and commodity exposure.
Sure.
Operating 100% unhedged just feels incredibly reckless for a business entirely dependent on global hydrocarbon prices.
See, I hear you. But the comparison to Chesapeake or other traditional E&Ps breaks down when you look at the liability side of the balance sheet.
How so?
TPL's CEO, Ty Glover, made a really profound point in this earnings call. He basically stated that for TPL, their strong balance sheet is their hedge.
Wait, really? Just the balance sheet?
Yeah. Think about it. TPL carries zero debt. None.
Yeah.
They have a massive net cash position. The existential risk for an unhedged E&P in a price crash is foreclosure by the creditors.
Right.
TPL has no creditors to foreclose on them.
So the distinction is that a price crash merely compresses TPL's margins, whereas it literally bankrupts a traditional driller.
Yeah, exactly.
Yeah.
They aren't paying interest on the asphalt of the highway, to use your analogy.
Right.
So if traffic slows down, they just collect fewer tolls and wait for the macro environment to recover. They don't lose the highway.
Okay, that makes sense.
And furthermore, they maintained a strong net cash position through the declining oil prices of the last 3 years without paying the massive premiums required for financial insurance.
Which saves them a fortune.
A literal fortune. And now that global oil and product inventories are rapidly depleting and prices are spiking, they are capturing 100% of the upside.
Pure upside.
Right. Chris Stedham, the CFO, provided extremely clear sensitivities on the call. They produce roughly 5 million barrels of oil annually. For every $10 per barrel increase in oil realizations, TPL generates an additional $50 million in annual revenue.
That is just pure, unfiltered operating leverage.
Yes, it is.
I mean, if geopolitical tensions or supply constraints push crude up $10, boom, $50 million drops straight to the bottom line without TPL deploying a single extra dollar of capital.
Or hiring a single new employee.
Or increasing their headcount, right? And Stedham didn't just give the sensitivity for crude, he broke down the natural gas liquids, or NGLs, as well.
The NGL sensitivity is equally critical because the production profile of the Permian Basin is evolving.
It's getting gassier.
Way gassier.
Yeah.
They receive production volumes of roughly 3.8 million barrels of NGLs annually. And for every $5 per barrel increase in NGL realizations, TPL generates an additional $17 million of annual revenue.
We should dive into those NGL dynamics for a second because the changing ratio of NGLs to crude in the Delaware Basin is a massive theme for operators right now.
It really is.
As these shale wells mature, the gas-to-oil ratio often increases. TPL isn't just exposed to crude, they are highly levered to the pricing of ethane, propane, and butane, which have entirely different end markets, right?
Yeah, completely heavily tied to petrochemical feedstocks and, global export demand.
So the unhedged posture across all three streams, crude, NGLs, and dry natural gas, means that any persistent global supply shock translates immediately into cash flow.
Absolutely. And management noted on the call that these supply disruptions are persisting longer than anyone anticipated.
Right.
I mean, even if the immediate geopolitical tensions resolve tomorrow, global inventories are so fundamentally depleted that prices could remain elevated for an extended cycle.
Which means the industry has a massive structural incentive to keep drilling. Which brings us directly to TPL's inventory of wells.
Yeah, the line of sight metrics.
Right. They reported 20.7 net line of sight wells. So to gauge the sustainability of this record revenue, we really need to understand what that metric actually represents.
Yeah, these aren't just speculative acreage designations.
Right. It's not just a patch of dirt. These are wells that are permitted, actively being drilled, or drilled but uncompleted, the so-called DUCs.
The DUCs.
That specifically broke it down in the transcript. 5.8 net permitted, 9.6 net DUCs, and 5.2 net completed but not producing.
But the most crucial detail about that inventory isn't just the aggregate number. It's the underlying physics of the wells being drilled.
Okay, break that down.
The CFO emphasized that operators are pushing increasingly longer laterals. New permits and spuds are averaging a lateral length in excess of 13,000 feet.
13,000 feet. That's
massive.
The evolution of lateral lengths in the Permian is just staggering to me. I mean, 5 or 10 years ago, a 5,000 or 7,500 foot horizontal section was considered standard.
Totally standard.
Now, operators are drilling vertically for 2 miles, turning the drill bit 90 degrees, and drilling horizontally through the shale layer for nearly 2.5 miles.
It's an engineering marvel.
The engineering complexity of completing a well of that length, managing the pressure, and ensuring the proppant actually reaches the furthest stages. It's immense.
And because a 13,000-foot lateral exposes vastly more rock to the wellbore, it produces significantly more hydrocarbons than those older, shorter laterals.
Obviously.
Right. So when Chris Stedham states they have 20.7 net line of sight wells, he is highlighting that on a net normalized basis, factoring in these massive lateral length, their line of sight inventory is actually up 11% sequentially.
So you are not just seeing a higher count of holes in the ground.
No. You are looking at vastly more productive, highly engineered drainage systems being installed across TPL's acreage.
And this massive increase in lateral length also demands an exponentially larger volume of water for the hydraulic fracturing process.
Which is music to TPL's ears.
Right, because an operator needs millions of gallons of water to fracture a 13,000-foot lateral. And TPL isn't just collecting oil royalties. They have a massive surface operation, selling the very water these operators need.
They do.
The earnings call noted that their water segment hit its second-best volume numbers in company history.
Yeah, the surface business is like the hidden engine of TPL.
I totally agree.
They sell the brackish water required for fracking. They sell the caliche and sand used to build the well pads and the access roads. And then, and this is the best part, they collect royalties on the disposal of the produced water that comes back up the wellbore.
They monetize every single phase of the extraction lifecycle.
Every single one.
It's genius. And honestly, if the earnings call had concluded right there with record free cash flow, zero debt, an unhedged 100% capture of rising commodity prices, and an 11% normalized increase in highly productive line of sight wells.
It would be a phenomenal quarter.
It would be an A-plus quarter. But the entire narrative of TPL shifts dramatically when Ty Glover begins discussing what they term their next-gen endeavors.
Oh, yeah.
Here's where it gets really interesting. This is where the 130-year-old land trust suddenly intersects with the bleeding edge of the 21st century economy.
The headline from the next-gen segment is the aggressive pivot into power generation and data centers.
Yep.
Ty Glover dedicated a significant portion of his opening remarks to this, revealing that TPL just sold a small parcel of land for $43 million, structuring the payments over a 20-year period.
$43 million for a small parcel.
Right. And concurrently, they signed a commercial water agreement to supply a gas power generation project on that exact same development.
Which is huge. During the Q&A portion of the call, an analyst from Texas Capital zeroed in on this, asking if this project was related to a known, previously announced partnership TPL has with a company called Bolt.
And it wasn't.
Right. Ty Glover explicitly confirmed it is not Bolt related. It is an entirely separate, new project. The sheer magnitude of this pivot requires us to look at the macroeconomic forces driving the artificial intelligence revolution right now.
If we connect this to the bigger picture, The primary bottleneck for the deployment of artificial intelligence is no longer software architecture.
No.
Or even access to NVIDIA's latest silicon. The absolute ceiling on AI growth right now is the physical availability of electricity.
Ty Glover used a very specific phrase on the call. He said, speed to power.
Speed to power, exactly.
Yeah. Speed to power has been the key to these projects all along. The major hyperscalers, the Microsofts, Amazons, Googles, Metas of the world, they are engaged in this frantic arms race to build massive data centers to train their next generation large language models.
And these clusters require gigawatts of continuous uninterrupted power.
Gigawatts.
Right. And the critical issue, which Glover noted, is that substantially all of the available grid power in Texas has already been spoken for.
The ERCOT grid.
Yeah, the ERCOT grid, which manages the vast majority of electrical power in Texas, is structurally constrained. I mean, you cannot take a power-hungry, multi-gigawatt AI data center and simply plug it into the existing transmission infrastructure.
It would blow the grid.
It would completely destabilize the grid. And the interconnection queues to upgrade those transmission lines are like measured in years, if not decades.
And if you were a trillion-dollar tech giant, waiting 10 years for public utility upgrades is just completely unacceptable.
The market share will be lost.
Exactly. So the solution to bypassing the public grid constraints is what they call behind-the-meter gas-fired generation.
Which is where TPL comes in.
Right. You physically locate a massive natural gas power plant on the exact same footprint as the data center. The electricity flows directly from the turbine into the server racks, completely isolating the facility from the vulnerabilities and capacity limits of the ERCOT grid.
But executing a behind-the-meter strategy of that scale requires three highly specific, geographically dependent assets.
Okay, let's hear them.
First, you need an immense, continuous tract of land in a regulatory environment that is business-friendly and permits rapid industrial construction.
Check.
Second, you need direct, high-volume access to cheap natural gas to fuel the turbines.
Check.
Third, and perhaps most crucially, you need access to colossal amounts of water to cool both the thermal power plant and the densely packed data center servers.
And check. TPL effectively holds a geographic monopoly on all three prerequisites.
It's almost unfair.
They own hundreds of thousands of acres of surface land located directly on top of the Permian Basin, which, produces a massive surplus of natural gas.
Yeah, associated gas is practically free out there.
And they already operate an established, large-scale water sourcing and infrastructure business. I mean, Ty Glover stated on the call, virtually every major hyperscaler and AI lab are evaluating large-scale plans in Texas. And our sense is that urgency to lock up power and compute continues to rise.
TPL is perfectly positioned to extract maximum value from this frantic land grab. I mean, Glover specifically cautioned analysts not to over-extrapolate the terms of the single $43 million deal they just announced.
Right, because every deal will look different.
Exactly, emphasizing that every developer's needs are highly customized. In some structures, TPL will outright sell the land parcel. In others, the primary driver of the contract will be a multi-decade commercial water supply agreement.
Or they might just leverage their surface business to provide the raw aggregates required to physically construct the foundation of the data centers.
Now, you win in every scenario.
And this flexibility to solve multiple critical path problems for these hyperscalers brings us to the most technically fascinating piece of engineering discussed on the call.
The desalination plant.
Yes, the Phase 2B 10,000 barrel per day water desalination test facility. At first glance, a water treatment plant sounds like a niche environmental project, right?
Totally. Just regulatory compliance.
But when you map the thermodynamics of this facility against the needs of AI data centers, it reveals a completely closed-loop thermodynamic ecosystem that solves the biggest problems of two entirely different industries simultaneously.
It is so cool. To understand the brilliance of this desalination project, we have to examine the escalating crisis of produced water in the Permian Basin.
Right, the toxic water.
Yes. When an operator hydraulically fractures a well, they pump millions of gallons of water down into the shale. When the hydrocarbons flow back to the surface, they bring massive volumes of hypersaline, incredibly toxic water with them. This is the produced water.
And it is a massive liability.
Oh, massive.
I mean, produced water is significantly saltier than ocean water. It is laden with heavy metals, volatile organic compounds, and naturally occurring radioactive materials.
You do not want this stuff on the surface.
No. Historically, the industry's only economical method for disposing of this toxic byproduct has been deep well injection.
Just pumping it back underground.
Pumping it thousands of feet back underground into disposal wells.
However, the sheer volume of water being injected over the last decade has fundamentally altered the subsurface pressure dynamics in West Texas.
It's causing earthquakes.
Literally. It is inducing seismic activity. The region is experiencing unprecedented earthquakes, and the Texas Railroad Commission, which regulates the industry, is actively cracking down.
Yeah, they are restricting deep well injection permits in highly seismic areas.
So the oil industry is facing a scenario where they might have to curtail highly profitable oil production simply because they have nowhere to put the toxic wastewater.
It's a huge bottleneck. Enter TPL's Texas Pacific Water Resources Division.
Yep.
Robert Crane, the executive vice president of that division, detailed their strategy during the Q&A. He described the Phase 2B facility as research development at scale.
Which means it's not a lab experiment anymore.
Right. They're constructing a plant engineered to clean 10,000 barrels of this toxic produced water every single day. If they can demonstrate that the economics of this process work at scale, they immediately solve the Permian Basin's most pressing regulatory and environmental bottleneck.
But the economic challenge of desalinating hypersaline water is the massive energy requirement.
It takes so much power.
It takes an unbelievable amount of power. Whether you use reverse osmosis or thermal desalination, the energy input historically makes the process prohibitively expensive compared to simply injecting the water underground.
Right.
And this is where the synergy with the AI data centers becomes the absolute linchpin of the strategy.
Because data centers and the natural gas turbines built to power them require massive volumes of water for cooling.
Yeah, West Texas is an arid environment.
Exactly. Fresh water is scarce, and the local municipalities and agricultural sectors are highly protective of the existing aquifers. I mean, a hyperscaler cannot arrive in a West Texas community and just drain the local drinking water supply to cool a server farm. The political backlash would be insurmountable.
So the proposed closed-loop ecosystem solves the energy cost of desalination and the water scarcity of the data center simultaneously.
Yes.
The natural gas power plant, operating behind the meter to power the AI servers, generates an immense amount of waste heat.
Thermal exhaust.
Right. TPL intends to capture that thermal exhaust and use it to power the desalination process for the toxic produced water coming from the oil wells.
It is an elegant thermodynamic arbitrage.
That's a great way to put it.
You are utilizing a waste product from the power plant, the thermal exhaust, to process a waste product from the oil field, the produced water.
And the output is clean, usable water.
Exactly. Which is then immediately cycled back to cool the very data center and power plant that facilitated the process.
It's mind-blowing.
If TPL successfully proves the commercial viability of this Phase 2B facility, they effectively synthesize a self-sustaining infrastructure loop that removes the ultimate constraints on both AI compute expansion and Permian oil extraction.
And Robert Crane emphasized on the call that this is not a theoretical model sitting in a pitch deck somewhere.
No, it's real.
The physical infrastructure is being deployed. He noted that a facility inspection is planned for later this month, and they expect to begin flowing inlet water barrels into the system in the coming weeks.
They are actively testing the commercial potential for waste heat capture and cooling co-location right now.
The confidence emanating from management regarding this transition is striking.
It really is.
I mean, when an analyst asked Ty Glover to quantify the total addressable market for these next-gen endeavors, he declined to provide a rigid dollar figure. But his qualitative guidance was monumental.
What did he say?
He stated, "We feel like multiple multi-gig energy campuses on our acres are viable."
Multiple multi-gigawatt energy campuses. A single multi-gigawatt energy campus represents a globally significant concentration of infrastructure and capital. We are talking about the power equivalent of a major metropolitan city, dedicated entirely to advanced computational processing, situated directly on TPL's surface acreage.
It represents a fundamental repricing of the asset base.
Completely.
Historically, a square mile of surface land in West Texas was valued on a fairly linear matrix.
Right.
Grazing rights for cattle.
No cows.
Cows, yeah. and the number of oil pump jacks that could be actively operated, and maybe some pipeline right-of-ways.
Right. But today, that exact same square mile is being evaluated by sovereign wealth funds and trillion-dollar tech monopolies based on its proximity to high-pressure gas pipelines, fiber optic backbones, and its viability to host multi-gigawatt power generation.
The intrinsic value of the land is expanding into dimensions that traditional valuation models simply cannot capture.
But, before we move to synthesize these data points into a final verdict on the stock, we have to acknowledge a poignant moment from the call that speaks directly to the philosophy required to recognize and hold this kind of asset.
Yes. The tribute.
Right. Ty Glover dedicated time to honor the passing of Murray Stahl. For those unfamiliar with the history of the stock, Murray Stahl and his firm, Horizon Kinetics, have been the largest shareholders of TPL for decades.
Yeah, Ty describes Stahl as a tremendous longtime advocate who believed in the company back when it was a thinly traded, obscure trust that most of Wall Street completely ignored.
And the tribute highlights a core philosophy of investing that is frequently discarded in today's environment of high-frequency trading and quarter-by-quarter algorithmic optimization.
Murray Stahl possessed a profound understanding of the virtues of real property combined with extreme patience.
Patience is key.
Right. He looked at TPL decades ago and recognized the latent, unreproducible value of the land itself. He held his position through massive cyclical volatility, through the boom and bust of traditional vertical drilling, through the technological revolution of horizontal fracking that ultimately unlocked the massive reserves of the Permian. And he watched TPL organically grow into one of the most profitable energy companies in the world.
Ty Glover captured that sentiment perfectly, noting, while other shareholders would come and go as our share price rose and fell, Murray and Horizon steadfastly remained our largest owner and our biggest fan.
Yeah.
TPL is actually hosting an event named in honor of Horizon Kinetics on May 18th in Midland, which serves as a shareholder tour and a testament to his enduring legacy. It stands as a stark reminder that generational wealth in the equity markets is rarely built by actively trading around macroeconomic noise.
It's built by accurately identifying fundamentally unique assets and possessing the ironclad conviction to hold them as the world evolves around them.
Stahl recognized the simple truth that they were not manufacturing any more land in Texas.
Yeah, they are not.
What the Q1 2026 earnings call demonstrates is that the utility of that land is expanding into technological applications that even Stahl might not have fully anticipated 30 years ago.
Right.
Yet his foundational philosophy regarding the primacy of the asset perfectly positioned his investors to capture that expansion.
Okay, so we have dissected a phenomenal amount of data from this call.
Let's bring it all together.
We have the record-breaking $136 million in free cash flow. We have the unhedged, zero-debt balance sheet perfectly positioned to capture escalating global commodity prices.
We have the 11% sequential increase in highly productive 13,000-foot lateral line-of-sight walls.
And we have the massive strategic pivot into off-grid AI data centers powered by behind-the-meter gas generation and cooled by thermodynamically integrated desalination of toxic produced water.
So what does this all mean? Looking at this zero debt setup paired with the AI lottery ticket, it feels like they've built a massive barbell strategy here.
That's exactly what it is.
Based on the fundamentals presented in this call, how should we evaluate the risk-reward profile of TPL right now? Are we bullish or bearish?
Taking a highly opinionated stance derived purely from the underlying mechanics discussed today, the verdict is unequivocally bullish.
Unequivocally.
Unequivocally. TPL currently offers a structural risk-reward asymmetry that is exceedingly rare in the modern market. The barbell concept you mentioned is the exact framework to use when analyzing this equity.
Let's expand on how that barbell functions for the retail investor. A traditional barbell investment strategy involves combining two extreme ends of a risk spectrum while completely avoiding the moderate, murky middle.
Right.
On one side of the TPL barbell, you have the ultimate defensive, cash-gushing, high-margin anchor, their legacy oil and gas royalty business.
And that legacy anchor requires zero capital expenditure and carries zero debt.
Which is incredibly safe.
Yeah. And because they are 100% unhedged, they capture the entirety of the upside generated by global oil price shocks. As long as the global economy requires hydrocarbons, and the continued depletion of global inventory strongly indicates it does, TPL will consistently print hundreds of millions of dollars in free cash flow, quarter after quarter.
Insulated from the inflationary pressures that compress the margins of traditional operators.
Exactly. That defensive side of the barbell guarantees survival and immense capital return.
You don't have to worry about a credit freeze or a high-yield debt wall bankrupting the company because they simply don't owe anybody any money, and their operational costs are negligible.
But typically, a safe, cash-generating dividend stock is inherently low growth. It functions like a bond proxy stable, but entirely unexciting.
Right, and that is where the opposite end of the barbell comes into play. On the other side, you have an explosive, paradigm-shifting call option, the AI infrastructure and data center boom.
It's the ultimate growth narrative.
By holding TPL, an investor gains direct exposure to the most aggressive, capital-intensive expansion cycle in the history of the technology sector, driven by hyperscalers who are utterly desperate for the exact assets TPL controls in abundance.
Contiguous land, off-grid power, and industrial cooling water.
The structural advantage for the investor is that you are not paying the massive speculative premium typically associated with AI exposure.
This is key.
If you purchase shares in a pure-play semiconductor manufacturer or a generative AI software firm right now, you are paying a valuation multiple predicated almost entirely on flawless future execution and uninterrupted parabolic growth.
And if the AI capital expenditure cycle slows down?
Those equities will experience severe multiple compression and just crash.
But with TPL, the AI data center optionality is effectively a free perpetual call option attached to a highly profitable defensive oil business.
It's free optionality.
All right. If the hyperscalers decide tomorrow that the economics of behind-the-meter generation in West Texas are no longer favorable and they completely abandon the concept, TPL does not collapse.
It just remains a record-breaking royalty trust,
yielding massive free cash flow from the drilling programs of Devon, BP, and Occidental.
So the absolute floor on the stock is incredibly high, supported by the legacy cash flow, but the ceiling, should these multi-gigawatt energy campuses aggressively materialize, is mathematically staggering.
It really is. So let's distill this into actionable takeaways for you, the listener.
Let's do it.
If you are a retail investor who already holds TPL stock, perhaps sitting on substantial long-term capital gains and questioning whether the narrative has fully played out, the data from this quarter is a blaring siren telling you the story is just beginning.
Just the beginning.
The transition from a passive oil trust to an active AI energy nexus is in its absolute infancy. The $43 million land sale is merely the first localized validation of the broader thesis.
And if you are an investor who is currently researching the stock and considering initiating a position, the critical catalyst to monitor over the next 2 to 3 quarters will be future corporate announcements regarding hyperscaler partnerships.
Yeah, Ty Glover explicitly guided that management anticipates providing updates on other significant opportunities as they progress throughout the year.
The commercial details of this initial project are actively being finalized, and the Phase 2B desalination plant is physically flowing inlet water this month.
The velocity of news flow originating from their next-gen endeavors is poised to accelerate rapidly.
You want to monitor their press releases and SEC filings with extreme scrutiny. Look for the specific code words that indicate TPL is successfully locking in the tech giants.
Right, phrases like behind-the-meter generation,
Commercial water supply agreements,
co-location facility,
and waste heat capture. Every time one of those phrases appears in a definitive agreement, it represents another brick in the foundation of that multi-gigawatt vision.
This raises an important question, though. The evolution of this company forces us to fundamentally reconsider how we view the market ecosystem surrounding artificial intelligence. Well, the dominant narrative dictates that NVIDIA, Microsoft, Google, and TSMC are the ultimate exclusive AI investments. We obsessively analyze their earnings calls for indications of compute demand, software integration, and algorithmic efficiency.
We do. We all do.
But if the single greatest bottleneck to the proliferation of artificial intelligence is no longer the underlying software architecture, no longer the fabrication of the microchips themselves, but rather the hard physical reality of acquiring off-grid power and massive volumes of industrial cooling water. Are legacy Texas landowners actually the most critical, unreplicable, pick-and-shovel AI investments of the next decade?
Wow. It is a profound realization that challenges the entire consensus of the technology sector. It demonstrates that in the capital markets, the most disruptive innovations and the greatest generation of wealth often emerge from the most unexpected, deeply unglamorous synergies.
Dirt and toxic water.
Dirt and toxic water. The ultimate technological play isn't necessarily being engineered in a pristine laboratory in Silicon Valley. It might very well be an unhedged, zero-debt land trust that was founded before the Wright brothers ever flew a plane at Kitty Hawk.
sitting quietly on top of the Permian Basin.
Engineering a way to turn toxic produced wastewater into the cooling lifeblood of the future economy.
The antique map isn't a relic.
It is the blueprint for the next industrial revolution. Thank you for joining us on this deep dive. Keep researching the mechanics behind the headlines, keep questioning the prevailing market assumptions, and stay insanely curious.